Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
Greetings, everyone. I'm Alison Hakamaki, Head of National Agriculture, Public Sector, and Emerging Industries at BMO Bank of Montreal, Canada. Not even a month after the 2024 U.S. election, President-elect Trump has threatened an across-the-board 25% tariff on all products from Canada and Mexico, effective on day one of his administration. These tariffs, he said, would remain in effect until Canada and Mexico take actions to stop drugs such as fentanyl and illegal aliens from entering the U.S. This was clearly a violation of the USMCA-CUSMA trade agreement that Donald Trump signed himself. But after an initial jolt, the financial markets reflect a somewhat buoyant mood, which would imply many felt this was simply bluster. However, the announcement was provocative, and if we learned anything during the last Trump administration, it's that we should expect the unexpected, and we need to prepare for anything. Further, the incoming administration will be very different from Trump's last one. Canada itself is very different politically from the last time we negotiated with the U.S. If implemented, the tariffs would have far-reaching consequences. The threat itself has many wondering, what steps do we need to take to prepare? And that's why we're here today, to share insights from both sides of the border. I'm very pleased to introduce our esteemed panel today. Steve Rahul is principal at GT & Co. and the former chief trade negotiator for Canada. Doug Porter is managing director and chief economist at BMO. Doug will help us understand the economic implications of higher tariffs among the North American trading partners. And Young-Yu Ma is the chief investment officer for BMO Wealth Management in the U.S. and will share insights on what the tariff threats mean for the markets. So Steve, I'd like to start with you. Given your decades-long experience as Canada's top negotiator, we'd love your insight on what prompted this bold announcement by President-elect Trump. Can you provide some context as to what led up to this point? What are the implications, and how will Canada respond?
Okay, well, good afternoon, everyone, and thank you, Alison. President-elect Trump has been interested in tariffs for a very long time. In his first term, he used a Section 232 national security tariffs against Canada, Mexico, and a number of other countries to impose tariffs against imports of steel and aluminum. He used another provision, Section 301 of the Trade Act of 1974, to impose tariffs against China. And he also looked at the notion of using the International Emergency Response Act to impose tariffs against Mexico, but never eventually went ahead with that. So he's a big fan of tariffs. He will continue to be a big fan of tariffs, we expect. And the way he looks at it is basically he sees four kinds of main benefits for tariffs. One is to ensure that he can try to bring production back into the U.S. In other words, countries or exporters would rather relocate to the U.S. than have to pay the tariffs. So he sees this as a mechanism to bring more production into the U.S. market. He would also like to address trade deficits with tariffs. That's also a major consideration. He'd like to match the trade levels that other countries have because U.S. tariffs tend to be lower than most other countries maintain at the border. So he wants to address that. And then he also wants to see tariffs as a source of revenue. So a lot of those issues are challenging to deal with, but I think President-elect Trump likes tariffs even more now and is less constrained about using them than he was in the first term. Fairly recently, he has been talking about across-the-board tariffs of 10% or possibly 15% that would apply against all countries. He's also talked about tariffs of at least 60% against imports from China. So the recent message about looking at 25% tariffs against imports, all imports from all sources from Mexico and Canada, is a bit of a new direction. We don't know what that means for the previous commitments on 10% tariffs across the board. That remains to be seen, but we'll see. If it happens that President-elect Trump does impose across-the-board tariffs of 25% against all imports from Canada and from Mexico, then clearly that will be a very significant hit to the economies of Canada and Mexico, since both of us rely highly on exports to the U.S. That's our primary export destination by a very wide margin. And I think clearly it would have some significant impacts on the U.S. economy as well. Our economies are integrated, supply chains are closely intertwined, and we would be in for a highly disruptive period of time if such tariffs were to be put in place. And if President-elect Trump did impose tariffs against Canada and Mexico of 25%, it would leave Canada and Mexico with worse access to the U.S. market than the 166 members of the WTO. And we would really be in a place where only Russia, North Korea, and a handful of other countries would have worse access into the U.S. market than the U.S.'s two largest trading partners. So there's a certain aspect of this that seems less than credible, but that doesn't mean we shouldn't be preparing for it. So obviously we have to do that. So I think the question now is, how will Canada respond? What is the strategy of the government to respond to this? Well, I think we don't have any real choice but to start by addressing the notional rationale for why President-elect Trump is making these threats. And that has to do with fentanyl and illegal migration across the border. Now, those issues, Canada certainly doesn't contribute much to this problem. Mexico contributes much, much more. We're a fraction, maybe 2% of the issue that is related to this. And it also goes against traditional approaches that would say that the country of import is the one that is responsible for maintaining its borders. But clearly, we're not in that kind of world. We get these kinds of messages from President-elect Trump, but we have no choice but to try to address the rationale that he has put out for making this threat. So the other part of the Canadian strategy is to try to establish relationships with the new team coming in. The Prime Minister's visit to Mar-a-Lago last week was an effort to do that. It did go ways in establishing relationships. It's always easier to pick up the phone and talk about something if you've had some kind of interaction with your counterpart initially. So that was overall a positive move. Another part of the strategy is to mobilize the private sector in the U.S. to oppose these tariffs and make that opposition known to the U.S. administration. And certainly we've seen comments from Walmart, a number of other companies, about how this would raise the price of goods considerably. The Canadian government is also preparing for the possibility that this could all go very badly. So that means looking at retaliation, imposing tariffs against imports from the U.S. The government is also looking at the potential of using export taxes as an additional means to put pressure on, as well as suspending some elements of the agreement we have with the U.S. and Mexico, the CUSMA. All of those are on the table at the moment. But part of the problem with retaliation is the scale, because a 25% tariff across $500 billion roughly of exports from Canada is a big number, and we would have to retaliate from Canada at very high levels in order to match that, and that is always a challenge. So we're in a very uncertain period right now. There will be an effort between now and when President-elect Trump takes office on January 20th to try to dissuade them from going in this direction. But if they do, then Canada will be prepared to take actions immediately and to send the message that this is an unacceptable step, particularly for his two largest trading partners.
Great. Thanks so much for that insight, Steve. Doug, I'd love to turn it over to you. Can you just frame things at the top by explaining what the motivation and what impact tariffs would have on the U.S. and Canadian economies?
Sure thing. And good afternoon, everyone. Thanks, Allison. So I'd start off by saying that, first of all, very big picture, the financial markets simply do not believe that this is going to come to pass. I think that's quite clear. For instance, if you look at the Mexican peso or even the Canadian dollar, there's very little change from pre-threat levels. And up until recently, the Toronto Stock Exchange had actually managed to reach an all-time high. So I think from a very big picture view, the financial markets simply do not believe this is going to come to pass. I suspect that that calm is highly questionable. I think we should take the threat seriously, or at the very least prepare and consider what broad-based tariffs could mean for the economy. In terms of motivation, I think Steve laid it out very well. I think simply put, the president-elect believes that tariffs are essentially a one-way street, that the U.S. economy pays very little price, and essentially the company that's doing the exporting to the U.S. ultimately bears the bulk of the cost. We can debate whether that's a correct assumption or not. I think there is some truth to that in some goods, but at the very least for the U.S. economy, I think when you throw sand into the gears of trade, especially with your two biggest trading partners, it does tend to have at the margin a stagflationary impact. So in other words, it will put some upward pressure on inflation at the very least. Some have suggested it could raise inflation by as much as 1% if we saw that extent of tariffs in the US. And if you are damaging your two largest export markets, that can come back on your economy and hurt growth. However, there is no sugarcoating. It is a much bigger negative potentially for the Mexican and the Canadian economy. In both cases, we export roughly, or I should say, 3/4 of our exports go to the U.S. And in both cases, exports account for roughly a quarter of GDP. So the arithmetic tells us that exports to the U.S. are almost 20% of GDP for both economies. The Canadian Chamber of Commerce has come out with an estimate that suggests that just as a standalone measure, without retaliation, a 25% tariff would carve about 2 percentage points off of Canadian GDP in the first year. That's just the first round effects. That doesn't even get into the chill that it would put into business investment. And that doesn't assume retaliation. If we get anything close to the kind of retaliation that Steve was talking about, you could see a cut in Canadian GDP of upwards of 3%. Now, I will say, above and beyond whatever the response is on the political side, there would be monetary and fiscal policy response, heavy-duty response. I think what we're talking about in the event of a broad-based tariff like that would be much deeper interest rate cuts by the Bank of Canada to support the economy. So, for instance, to put some numbers around that, we've been assuming that the Bank of Canada would take interest rates down to about 2.5% for their overnight rate from 3 3/4 at the moment. I could see another at least 1 percentage point cut above and beyond that. So we'd be talking about a 1.5% overnight rate in the event of the extreme event of broad-based tariffs. I could also see a fiscal response. In that world, I think the government would be quite reasonable to provide all kinds of support to basically boost the parts of the economy that they could control. I think we'd be talking, roughly speaking, on the order of about 0.5% of GDP of fiscal support. And I think all of those things, along with some depreciation in the Canadian dollar, could limit the damage to some extent. Our best guess is that it would lead to about a 1% decline in GDP in the first year. But again, those are just the first round direct impacts. And it would also skew growth more towards the domestic side. So in other words, there'd be much more emphasis on consumer spending and housing, with obviously a much weaker environment for exports and business investment. Not a great outcome for the Canadian economy at all.
That is great insight. Thank you very much, Doug. Young Yu, I'd love to turn it over to you as our representative from the U.S. I know you've been following this really closely. So just to get sort of your opening thoughts, as it pertains to the current threatened tariffs and, even as a precursor to a renegotiation of the USMCA that Trump likely has in store. So would you like to open up with some thoughts for us, please?
Yes, thank you, Allison, and good afternoon, everyone. I do think it is important to think about and understand well the context, both of which President Trump thinks about tariffs and trade, and also the people he's putting in place, or he plans to put in place, such as U.S. Trade Representative Jamieson Greer, Tom Homan, the borders are, what they've been talking about as well. But first, President Trump, in terms of his approach to tariffs and how he views these, one big part of that is to enact domestic policy goals. It's not purely about economics, eliminating deadweight costs like we learned in Economics 101. It's really about affecting and enacting the programs and policies that the president believes are important. So one of those is, as was mentioned, bringing back manufacturing to the U.S. I do believe that President Trump is very serious about that topic in particular, but there's also a broad range, as we see now, of geopolitical goals, topics, leverage that the president might want to impose on other countries. In this case, the topic of under discussion for these threatened tariffs is control of the border, or better, oversight of the border. And we'll talk about what this context means for how we think the likely outcome is going to be. But part of that is also why we think Trump 2.0 is very different and meaningfully different than Trump 1.0. In Trump's first administration, first term, he was an outsider, not just a political outsider, but he was a Republican outsider. He didn't have a lot of buy-in from even his own party. Right now, he has a very firm control of the Republican Party. So some of the opposition that might have stood in the way of tariffs, for example, which has not been part of the Republican platform historically, a lot of that is much weaker today than it was 8 years ago. Another point which is worth understanding is that President Trump did win the election in what is somewhat of a landslide. He won every single swing state. He won the popular vote, which no Republican president has done in 20 years. And it is something where he believes he has a mandate to enact some of the changes that he's been talking about on the campaign trail. Beyond that, the courts are very much stacked, or at least tilting in the favor of the president. So there's not going to be a lot of pushback if the president invokes national security grounds or emergency powers relating to tariff imposition. So there's not a lot of these checks and balances the way there may have been 8 years ago, which is, to Steve and Allison, your comment as well, these are going to be less constrained. There are less constraints on the president than there were 8 years ago. And it's also the case 8 years ago, President Trump was focusing on tax cuts. As we know, once he got in office, that was the big signature policy, was cutting taxes. Tariffs on China only came later after that tax cut package was a done deal. In this round, tax cuts are going to play a much smaller role because given the budget situation in the U.S., there's just not a lot of room for substantial tax cuts beyond extending the tax cuts that were enacted in 2017. So really tariffs and trade and this idea of trying to bring back manufacturing are really going to be front and center in the government's policies. And if you listen to the who is to be appointed as U.S. Trade Representative Jamieson Greer, one thing he points to is the administration now has data. And what they believe from President Trump's first term was that there weren't all these negative effects of tariffs that were predicted or talked about. So they seem more emboldened this time around in terms of using tariffs more aggressively than in the previous term. So what does that mean? Well, it does mean, I think, in this instance, when we're talking about border security, in particular, Tom Homan, the to-be-appointed border czar, has talked about it's a crisis at the border. Yes, it is something that Canada is probably going to, in order to appease some of the U.S. President Trump's insistences on this point, make some efforts with. But it's also something to think about these threatened tariffs in the context of renegotiation of USMCA. And that's definitely something that is on the docket for the Trump administration prior to 2026. And it's something where President Trump is likely thinking about this in somewhat of a repeated game type of game theory mentality. And how this plays out, we do think that, as Steve mentioned, the 25% tariffs are not credible. And that's not something we would expect even to remotely come to pass across the board. We think the question is whether or not President Trump puts some tariffs on certain industries, certain goods, and leaves those there as sort of a negotiating chip for USMCA in later rounds, as something that he can sort of put out there as bringing off the table and putting those tariffs on to begin with in the earlier days of the administration. So we do think that there's this dynamic in play that's a little bit difficult to predict, even if we don't get the 25% tariffs, that there could be some targeted tariffs that take place. But Canada has a nice position in terms of the one thing it has is what I would say a special relationship with President Trump. And it's not the way that we think about a special relationship here in the US, where I think about a special relationship with Canada, our neighbors, our colleagues, our friends. For President Trump, it's about oil. And Canada exports a lot of oil to the US, and that is very central to President Trump's initiatives. And it's going to become more central later after President Trump takes office, because he's going to want to turn the screws on Iran, and that's going to bring very likely to bring oil off the market, and that Canadian oil is very important. So I do think there's a path to all sides coming together on this with minimal effect, but it's going to be a very bumpy process. And President Trump is definitely more emboldened with tariffs this time around than he was in 2017, 2018.
Thanks. Thanks so much, Young Yu. Steve, I'd like to turn it back to you. There's been some talk about retaliatory efforts on the part of Canada. And so I'm hoping you could talk to us a little bit about how Canada responded during the steel and aluminum tariffs several years ago. What did they learn, and how would they be approaching that this time?
Well, whenever the government initiates some kind of retaliatory response, there's a basic kind of formula that's followed. First of all, you try to avoid putting any kind of inputs on the list, inputs to further manufacturing, for example. You try to avoid capturing products that aren't produced in Canada, or substitutes are not readily available from other sources, including other trading partners. Those tend to be put off the table, and you focus on areas where you try to cause the maximum damage or irritation in the U.S. market. So last time around with steel and aluminum, we covered steel and aluminum for one thing as a response. We also tried to target products that would be sensitive in particular regions, political regions in the U.S. So we went after washers and dryers and fridges, those kinds of things. We went after certain types of luxury products like boats and yachts and those kinds of things, although we got a lot of complaints back when we put those on. But it's really trying to target specific regions of senators or influential people and try to hit them there, which is why we went after certain types of whiskeys as well. So it's all based on an attempt to try to cause the maximum negative reaction in the U.S. Now, when we're talking retaliatory tariffs, the U.S. is looking at doing this across the board, applying tariffs to everything, including products they need, like oil, including products they don't produce, which doesn't make a lot of sense either. But Canada's response is most likely to be more targeted. It won't cover issues like that where we need the products, like their inputs, as I said, or we don't have any other sources. And we will focus in on those products that we think could do the most damage in terms of impacting the U.S.
Thanks very much. And another question on everyone's mind, Doug, is how are these threats impacting the foreign exchange? And then what do we view as the outlook as we approach 2025?
So it's interesting, almost the moment that the post went out last Monday, the first reaction right across the board was a very sharp weakening in the Canadian dollar and the Mexican peso. And I do think that was the right response. Ultimately, this is how the threat of tariffs can be partially countered or blunted, is through an appreciation of the U.S. dollar or a depreciation in the targeted countries. It certainly will not be enough. No one wants to see a 25% depreciation in the peso or the Canadian dollar. But given the kind of landscape I was talking about before, some of the monetary and fiscal policy responses we could see, if we were really facing an across-the-board tariff of something on the order of 25%, I think a depreciation of the Canadian dollar of 5 to 10% from current levels would be within reason. It's entirely conceivable. And we've been there before, by the way. It's not recently, but we have been to around the 150 mark or 66 cents. And if the end result is a much more limited tariff, say 10% across the board, or 20% on certain items rather than on all products, then of course the currency response and the macro response would be much more limited. But I do think the direction is right. Insofar as we do face pressure from certainly our largest export market, and the threat of tariffs and weaker, a weaker investment climate, I think the right response is a weaker currency. Now, before all of this, we had been assuming that the underlying domestic economy was actually starting to turn. And there's been a number of indications that the Canadian consumer is getting off of the map. We're seeing, things like housing and auto sales really beginning to stir again in Canada. Even the relatively soft GDP report last week, we did see some strength in consumer spending. So we actually believe the economy was moving to a better space next year, and that the Canadian dollar might actually begin to appreciate somewhat. But of course, this entire tariff threat has just knocked that off the board. And I think that, the currency will really struggle. Even if the tariffs are not applied, I think the currency will struggle to appreciate next year.
Thank you. Yes, I know just from the line, speaking with a lot of our commercial customers, a lot are reaching out to our foreign exchange experts to talk about their hedging strategies. And so there's definitely a lot of interest on how we can protect ourselves during this period of uncertainty and volatility. Young Yu, I'd love to probe a little bit more about how you're viewing the markets overall. So beyond the tariffs, how do you feel that President-elect Trump's presidency could have broader implications on the markets going ahead? And how are you viewing this?
Yeah, that's a great question. We do think tariffs pose a real risk, both in terms of disruptions to trade, potential inflationary impacts, what the Fed is going to do, how much latitude the Fed actually will have to cut rates in 2025 is probably relatively modest because of some of these concerns. There is strength. There is underlying strength in the U.S. economy. We know that's the case. We think that's going to continue. Productivity is going to continue to be strong. And that actually plays into President Trump's hands in terms of when he's looking at what he can do with tariffs. And again, there's a nice 45-minute interview with Jameson Greer where he talks about this, who's going to be the U.S. trade representative under President Trump, and talks about that, yes, this could be disruptive to markets. They can accept that in the short term, but they think there are going to be other tailwinds to markets, such as they come from deregulation, they come from lower oil prices, they come from a strong economy that gives them some latitude to make these tariff moves to try to enact or push forward the policies that the administration wants to push forward. So yes, the U.S. economy, we think, is going to continue to remain strong, that the markets, even though there's likely to be more volatility in 2025 than there was in 2024, more bumps along the way, that it's still a favorable trajectory. But that said, the administration is also looking at those favorable dynamics and thinking that that gives them more cushion to take some more aggressive actions in this regard.
Thanks so much. Well, there is a lot for businesses, consumers to be thinking about. I would love to have some of your closing thoughts. And Steve, you've been in the thick of it. So what do you think? Where do we go from here? And what are you going to be watching for in the near term?
Well, I'll be watching for how quickly the U.S. moves, because I think if tariffs are put in place initially, as he's threatened on January 20th, then there will be a bit of a scramble to try to find a way to deal with that. I think it won't take long to try to steer this into an actual negotiation. We have a review of the agreement coming up in 2026, but that's kind of the end point. 2025 is really going to be the negotiating period. So I think there's a good chance that all of these tariff discussions will start to evolve into a renegotiation of the agreement, and we would attempt to address some of those issues within that negotiation. So hopefully short term, but it's going to be a rocky period and a lot of chaos in the market.
Thanks. Young Yu, what are your final thoughts? What are you going to be watching for?
Right. In terms of this specific issue, really watching to see what some of the news flow is and statements that are made specifically about some of the border security that the Trump administration is requesting, or the incoming Trump administration is requesting, be strengthened, and then President Trump's response to that, and Tom Homan, the soon to be appointed border czar, his response to that as well. I think that's going to give us a lot of direction on what's going to be happening on day one in terms of these potential tariff threats. But my suspicion is there will be enough action that this concern will be largely alleviated by Inauguration Day, which is January 20th, but it may not be completely alleviated. And there still could be lingering issues or potential for President Trump to say, let's wait to see that these talked about measures are actually enacted and that are bearing fruit and seeing results, and putting on some nominal amount of tariffs until he's satisfied that those results are seen. So I think what comes out of both the Canadian side and the US side is going to be very impactful in the coming weeks.
Thank you. And over to you, Doug, for your final thoughts about where do we go from here and what are you going to be watching?
Well, I think if we pull all the threads together from what we've just heard, I think the main message is even if this is, if this threat does tend to pass, the reality is we're dealing with an overtly protectionist president who is very fond of using tariffs, who will continue to threaten some major trading partners, even friendly trading partners, with the potential of tariffs. I think we are going to be living with much more trade uncertainty than what we're dealing with, arguably even more so than in the first Trump administration. And unfortunately, I think what that means is ultimately we are likely looking at a chill in business investment in Canada, especially investment aimed at exports. And it ultimately means that will have to be compensated somewhat at the margin lower interest rates and a weaker exchange rate than would otherwise be the case to support growth in other areas. And we're probably going to end up with a little bit more of a tilt to consumer spending and housing and as I said earlier, less on exports and business investment. And it's a challenge, no question, for the Canadian economy.
Well, given that, I would encourage all of our customers, be it commercial or consumer, reach out to your BMO experts. We're here to help navigate through this uncertainty. We've covered a lot of ground exploring the implication of these tariffs and what they could mean to business and consumers. And I just want to sincerely thank Steve, Doug, and Young Yu. Your insights have been very much appreciated and valued. Thanks to everybody, and I hope you have a great rest of your day.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.